They called it a nation built on promises, paper stamped with signatures, ledgers kept by candlelight, and the slow, relentless service of interest. In the late 17th century, Britain discovered a new kind of arms factory, not a dockyard or foundry, but a market where private savers and merchants could lend their money to the crown, and in return watch the state turn that promise into ships, soldiers, and treaties. How did an island learn to buy an empire with credit? And what ghost of that bargain still haunts modern money? The story begins in a restless London of smoke and docks, where merchants who could see the world as goods, but not its security, proposed a bold trade with the crown. Lend us the cash, and we will provide regular pay for the navy and an orderly way to handle wartime expenses. That proposal became the Bank of England in 1694, a private company with a public purpose, and with it, the first durable mechanism for turning scattered private capital into reliable, state-backed funding. Suddenly, the government could promise to pay, and private financiers could treat those promises as tradable assets, giving scale to what had once been small, ad hoc loans. What does a nation look like when its power rests on the credibility of paper rather than the weight of gold? Credit needed a language, and Britain gave it names and contracts. Over decades, ministers and financiers perfected the idea of funded debt. Consolidate disparate IOUs into a single, marketable instrument, so people could buy and sell the right to future interest. The great innovation was not simply borrowing, but creating securities that were liquid and trusted, instruments that merchants, aristocrats, and foreign bankers would accept as wealth. When the state could borrow at low rates against a promise it actually kept, it could finance a navy that circled the globe and an army that held ports and presidencies. What happens next, when the promise becomes an engine of power rather than a tool of emergency? That engine required discipline and spectacle in equal measure. Britain's experiment with public credit produced extraordinary results and frightening excesses. In 1711, the South Sea Company offered to manage and consolidate national debts by swapping them for shares tied to colonial trade. The idea sounded modern. Turn public debt into private enterprise, harness merchant appetite for profit to reduce state obligations. For a moment, the system seemed magical. For a year in 1720, the fever of speculation turned paper into gold in investors' minds, and then the bubble burst, ruining fortunes and revealing how fragile faith in credit can be when greed outruns fact. The South Sea episode taught a bitter lesson about the gap between expectation and reality, and it left a scar on the way Britain handled large-scale finance afterward. Did the crash tame risk, or only teach financiers how to hide it better? Yet scandal did not stop the machine. It refined it. As the century moved on, the state learned to consolidate its obligations into instruments like the consol, a kind of perpetual bond that made government debt a lasting, tradable asset. Consols and similar securities created an enormous liquid market for sovereign credit, one that could be tapped repeatedly. The result was not only cheaper borrowing, but also a rerouting of private wealth into the public service of empire. Port defenses, convoys, garrisons, and distant administrations. The credit markets did more than fund war. They disciplined politics. Ministers who could not maintain market confidence found themselves politically exposed, and the credibility of a government's promise became a form of soft power. How far would a polity go to preserve that confidence, even at the cost of taxes, war, or moral compromise? The true scale of Britain's experiment revealed itself during the age of total war. By the end of the Napoleonic conflicts in 1815, the public debt had swollen to levels that would shock modern eyes, a burden measured in hundreds of millions of pounds, and by some estimates peaking near $1 billion, a sum that meant debt-to-GDP ratios far above those of peaceful times. Yet that mountain of IOUs had a paradoxical effect. It financed the fleet that enforced trade routes, the diplomatic ties that secured markets, and the colonial administration that turned local revenues into predictable streams. In other words, Britain's credit system converted borrowed money onto the institutional scaffolding of an empire. But could the economy sustain such a heavy load of promises without paying a political or social price? Credit did not act alone. The East India Company and similar corporate hybrids intertwined state finance, private profit, and overseas conquest. These trading corporations were lenders, borrowers, tax collectors, and territorial rulers all at once. They provided loans to the state when needed, and the state in turn protected their monopoly and legal privileges. In places like India, the company's rule began as commercial dominance and hardened into political power, paid for on both sides by bills, dividends, and the steady servicing of debt. The result was a system where private capital underwrote imperial administration, and imperial revenues fed back into the circuits of British credit. What moral arithmetic allowed men in London to call dividends trade returns when they were paid out of tax-farmed revenue half a world away? There were human stories inside the ledgers. In port towns, merchants, clerks, and widows learned to live on coupon payments. Small annuities financed modest livelihoods and tied ordinary citizens to state stability. At the same time, the heavy fiscal demands of empire meant new taxes and occasional hardship for those in the shadow of the fleet. Soldiers went unpaid when credit wavered. Dock workers' wages fell when commerce slowed. The bank, the consuls, the company charters, each was a promise with a human face, and when promises bent, people paid the cost in bread, labor, and unrest. If credit is a social contract, who exactly was part of that contract? The technicalities mattered. The ability to issue long-term, marketable debt meant Britain rarely had to loot or plunder to pay for its wars. Instead, it could tap savings at home and abroad. Trust itself became an export. Foreign bankers held British stock, colonials accepted sterling, and merchants priced risk against the soundness of London's markets. Over time, these practices set templates for modern sovereign finance. A state that borrows with credibility can wield power without immediate fiscal ruin. But the template had risks: concentration of credit, moral hazards, and the political need to sustain investor faith sometimes pushed governments toward decisions they might otherwise avoid. What modern political choices are being shaped by the quiet pressure of distant bond markets? We live in the shadow of that model. The idea that governments can borrow to smooth crises, build infrastructure, or wage war is now global. Modern central banks, the bond markets, and sovereign debt practices trace a long line back to the English experiments in funded debt and market confidence. The lesson is both blunt and subtle. Credit magnifies capacity, and it magnifies character. A navy bought on reliable annuities can carry a flag across the sea, but the same system can tie a nation to distant obligations and moral blind spots. If history's ledger balances on trust, what will break it when trust falters? In the end, Britain did not simply win an empire through arms and courage. It built an architecture of promises that translated into global reach. The Bank of England, consoles, the trading companies, and the great speculative frenzies were not incidental amusements, but the financial grammar of power. That grammar still speaks today, softly, from the pages of government debt reports and the screens of trading rooms. If you listen closely, you can hear the same question echoing, what price are we willing to pay now so that our children inherit an empire of conveniences instead of a ledger of unpaid promises? If this changed the way you see money and empire, stay with us and don't forget to subscribe. We will follow the money to the next ledger, the next promise, and the next moment where credit reshapes history